Welcome to the Dubai Wealth Blueprint podcast, presented by Poseidon Real Estate International. This is where we analyze property markets the way serious investors do, beginning with macro conditions, jurisdictional strength, and structural fundamentals before ever discussing individual assets. Because disciplined investors understand something important. Before asking what to buy, you must first understand where capital is safest and most productive to deploy. And moments of geopolitical stress often reveal more about a jurisdiction's strength than years of stability ever could. Right now, the UAE is providing a real-world demonstration of institutional resilience. While global headlines focus on conflict risk and supply chain disruption in the region, the UAE government has confirmed that the country maintains strategic reserves of essential commodities sufficient to cover 4 to 6 months of domestic demand, even if nothing else were to enter the country. That means that even in a scenario where trade routes were temporarily disrupted, the UAE would still be able to maintain normal economic activity for months. For investors evaluating jurisdictional risk, that is not a small detail. It's a structural advantage. And importantly, this preparedness didn't emerge overnight. The origins of this system go back to the COVID-19 pandemic. In early 2020, when flights stopped and global logistics networks stalled, governments around the world suddenly realized how dependent modern economies are on international supply chains. For the UAE, the issue was particularly important. The country imports more than 90% of its food supply. Rather than accepting that vulnerability, the government moved quickly to build a long-term framework for food security and supply resilience. In March 2020, the UAE introduced the Law of Strategic Stock for Food Commodities, establishing a legal framework requiring the maintenance of secure reserves in partnership with private sector suppliers. At the same time, the National Food Security Strategy 2051 was accelerated. Its goals were clear: increase domestic food production, strengthen local manufacturing capability, invest in agricultural technology, and build diversified international trade partnerships. Dubai also launched Food Tech Valley, an agricultural innovation hub designed to significantly increase domestic production using advanced technology. This wasn't a short-term policy reaction. It was long-term infrastructure planning. The operational infrastructure supporting this system is equally important. The Ministry of Economy monitors stock levels daily through a specialized digital platform connected to more than 600 major retail outlets across the country. This allows the government to track supply levels, prices, and availability in real time. Since the recent tensions began, authorities have conducted hundreds of inspection campaigns across the Emirates to ensure supply stability and prevent price manipulation. Strategic reserves are also distributed across multiple Emirates, creating redundancy in the system. In other words, this is not just a stockpile. It's a coordinated national logistics network. For investors, this conversation is not really about food. It's about institutional preparedness and governance capability. When you allocate capital into property in a particular country, you are not just buying an asset. You are indirectly allocating capital into policy decisions, regulatory stability, crisis management capability, and long-term economic planning. The jurisdictions that prepare for shocks tend to handle crises very differently from those that simply react when problems emerge. Preparedness reduces volatility, and reduced volatility increases investor confidence. This is one reason global capital continues flowing into markets that demonstrate operational competence during periods of stress. There is another important dynamic worth noting. For many Western economies, instability in the Middle East creates inflationary pressure and energy shocks. But for the Gulf Cooperation Council, the GCC, the economic effect is often the opposite. Higher oil and gas prices increase revenues for the region's producers. At the same time, GCC countries maintain some of the largest sovereign wealth reserves in the world, collectively exceeding $4 trillion. That fiscal strength allows these governments to absorb short-term disruptions while continuing to invest in infrastructure, diversification, and economic development. In other words, the economic resilience of the GCC during geopolitical stress is not accidental. It is structural. For investors, moments like this reveal something important. Most people analyze assets. Serious investors analyze jurisdictions. They ask, how stable is the governance framework? How prepared is the country for disruption? How resilient is the economy under stress? Because over the long term, the strength of the jurisdiction often matters just as much as the quality of the asset itself. Preparedness is rarely visible during calm periods. But during moments of uncertainty, it becomes very clear which countries planned ahead and which ones didn't. For investors allocating capital globally, those distinctions matter. Because in the long run, where you invest can be just as important as what you invest in. If you're allocating capital into Dubai and want to approach the market with a disciplined, investor-first framework, that's exactly the conversation we focus on at Poseidon. If you want to understand how Dubai and the UAE fits into your broader wealth blueprint, strategically, globally, and aligned to your personal capital structure, connect with us. Our details are in the episode description. Thank you for listening, and as always, invest with data, build with strategy, create real returns.